All right, welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Now, I normally do say welcome back, but of course, if this is your first time listening or if you've recently kind of discovered us, then a very big welcome to you. We've got a huge back catalogue, so there's plenty for you to explore. Just rough explanation each fortnight. I put out an episode that's just me talking, generally aimed at perhaps people 50 plus, and then my colleague Nick, he puts out the Wealth Builder podcast on alternate fortnights, and his content is generally a bit more skewed towards people in their 30s and 40s, but there's definitely crossover between each, so pick and choose as you wish. All right, well, this week we're having a look at companies and trusts, which is an interesting space post all the federal government changes. So for decades, if you asked accountants, lawyers, financial planners what structure was best for building financial wealth, the answer was very frequently a discretionary family trust. Trust became the default vehicle for successful business owners in particular, but sometimes also for professionals and investors with significant wealth. They offered flexibility, tax advantages, asset protection, and a relatively straightforward way to pass wealth down between generations. But what if the rules change, which is indeed what's happening? What if some of the biggest advantages of trusts are removed? So in the wake of the federal budget proposals around family trusts, negative gearing and capital gains tax, we might need to rethink some long-held assumptions. In fact, one structure that many investors have largely ignored for years might be about to make a comeback, and that is the humble investment company, or just a company structure that doesn't actually have a trading business, but just holds investments. So today I want to explore why companies may increasingly trump trusts in this new world, and why investors building long-term family wealth should at least be considering this possibility. Okay, before we go forward, it's worth understanding why trusts became so dominant in the first place. Traditionally, trusts offered four main advantages. Firstly, they allowed income to be distributed to different family members in a tax-effective manner. And in particular here, it's a discretionary family trust. So you can, with discretion, allocate to one family member, all family members. The proportions can alter, that sort of stuff. So very flexible in terms of how it paid out distributions. Secondly, trusts generally qualified for the 50% capital gains tax discount, the same as we have traditionally done as individuals. Third, they provided a level of asset protection, so a little bit of protection there. It's not in your own personal name, the assets. And fourth, they offered flexibility in estate planning because no individual actually owned the trust assets. So the word trust kind of points to that, but the assets are held in trust for the beneficiaries of that family trust. So these benefits have been substantial. If a family trust generated $100,000 of investment income, that income could potentially be distributed to family members who are on a lower tax rate, and it was often used to distribute to children in early adulthood. So they might be 18, 19, 20, 21, maybe they're going to uni, and you might distribute some money out to them. But it could also be, one member of the couple's retired or not working, you can distribute out to them. So it provides those sort of advantages. If a property or a share portfolio was sold after they've been held for 12 months, then you get the 50% discount. Only half the gain becomes taxable. So for many families, these sort of advantages pretty hard to beat. Now, the challenge though is that these advantages are largely disappearing. So once the changes come into effect on the 1st of July 2028, so we're still, there's a bit of time, family trust distributions will be subject to a minimum tax rate of 30%. So even if you distribute some money out to your 18-year-old son or daughter who is just a full-time student, they're going to have to pay 30% tax on whatever you give them anyhow, even though their marginal tax rate might be zero or the lowest one, which is 16%. So that removes a lot of the often, use case for a family trust. At the same time, changes to capital gains tax rules, and in particular the requirement that there's a minimum tax of 30% on capital gains, well, that further erodes the value of running it through a family trust. Now, I should flag that as I record this, these changes haven't yet come into effect. However, the understanding is that the government, with the support of the Greens, has the numbers to get this passed. So anyway, if things change in the next couple of weeks, I don't know, perhaps this episode never goes to air. But just to flag, as I'm recording this, I'm working on the assumption that there's no weird hiccups as it goes through the Senate. So for years, look, governments have particularly Labor governments, increasingly viewed trusts as tax planning vehicles. And, whether you agree with that or not doesn't really matter. It suggests that trusts are continuing to attract legislative attention. If all income from a trust attracts at least 30% tax, and if it loses the CGT discount, then many of the historical tax advantages have evaporated, right? And that's where companies become interesting. So they're a bit of a forgotten investment structure, but they've never really gone away, and many successful families have used them for a long time. But the main issue where they were inferior to a family trust was that companies never got the 50% capital gains tax discount. Now, the company tax rate is 30%, and so companies would simply pay at 30%, which is higher than even if you're on the top marginal tax rate of 25. Well, a 50% discount on that means you're paying capital gains of 22.5, right? So 22.5 versus 30 for a company. So therefore, from a capital gains tax point of view, it was considered always better to not have those kind of assets in a company. But now that difference is gone, right? Because you're paying 30% capital gain as a minimum, whether it's in your personal name, whether it comes through a trust, however you do it, 30%'s the deal. As a minimum. So that really changes your thinking in terms of a company. So let's imagine two identical portfolios, right? One sits inside a family trust and the other inside an investment company. They both got a diversified portfolio of ETF and shares, which means that they earn some income. Occasionally they sell some investments. Now, if they're both paying 30% tax, and neither of them receive a capital gains tax discount, then the trust's historical advantages have largely vanished. But the company has one very powerful feature that trusts never do, and that is that it can retain its profits. So this has probably been, because the focus historically has been trusts, the ability of companies to retain profits has probably been a little bit kind of underrated or underappreciated. But a company can earn income, pay its 30% tax, and then just retain the remaining profits for future investments. I mean, in most businesses, that's exactly what you're doing. You're reinvesting. So, yeah, there's no need to decide, who should receive what. You don't have to worry about beneficiaries moving between tax brackets. A company can simply continue to accumulate wealth. So if your objective is to build a pool of capital that might last for generations, that's a really compelling characteristic. In many ways, it resembles the attraction of superannuation. Money stays within the structure and continues compounding. And of course, it's compounding that's the engine, that's the secret sauce for all wealth accumulation. In contrast, if you've got a family trust, you have to pay out the distributions every year. Now, of course, you could put those distributions back in, but nevertheless, it's clunky, right? Whereas a company just doesn't have that. A company, you can just retain all the profits if you wish. So, yeah, fantastic from the perspective of compounding and building wealth. There's another difference, which is around passing through the generations, right? So if you have a company and the founder passes away, right, then let's say it's their children that are the beneficiaries most commonly. They can leave the shares in that investment company to their children. And by doing that, actually the investments that sit within that company are not disturbed. So it doesn't trigger any capital gains. The ETFs remain exactly as they are. The company's the same. The only thing that changes now is there's new owners of that investment company. And so that family wealth continues. Now, family trusts could do that too, right? You could, you had the beneficiaries, and if other beneficiaries died, then they kind of fell out of the trust. But the problem is that trusts have a fixed lifetime, 80 years. They can't go more than 80 years. It's called the vesting date. So when you hit that expiry of the trust, the assets have to be distributed out to all the beneficiaries. But companies don't have that limitation. A company can last forever. There are companies operating today that have been around more than a century. So for families thinking of multiple generations rather than a single lifetime, permanence matters, right? A company structure can become a long-term family investment vehicle that survives founders, children, grandchildren, beyond. So, it's not inconceivable to think of a circumstance where, someone at some point builds a successful business, however they do it, successful in their profession, generates more income than they require to live, and so has this excess, builds it up in a family investment company, and then on their passing, the shareholding in that company just passes to the next generation. That generation perhaps takes some dividends along the journey, but is able to let the capital just continue to roll, and that process could continue for generation after generation after generation, such that the great grandkids could still be getting dividends out of that pool, 100 or more years down the road, right? It's pretty fantastic if that's a driver for you, and it might not be. I mean, if the die with zero is another approach, right? So this is kind of at the opposite extreme, but nevertheless, it's just something to think about. Now, nothing's perfect, right? So companies are not a silver bullet. They do have a major weakness, and that is that if someone wants money, everyone has to get money, right? So whereas with a family trust, you can say, this particular beneficiary, they need some money this year, fine, we'll send you money, but the rest of us don't really. So long as overall the trust distributes its income, it doesn't really matter who it goes to. But with a company, distributions are paid out as dividends, and dividends are determined by how much of the company you own. So if there was 4 people, say, and each of them owned 25% of the company, then if you had a $100,000 dividend that you wanted to pay out, well, then each person has to get $25,000, even if it was the case that actually only one of them wanted money and the other 3 didn't really, because they were already working, maybe they're already on the top marginal tax rate. But with a company, there isn't that discretion, right? If you're declaring a dividend, then all shareholders are going to receive that dividend. So, look, as I say, nothing's perfect, right? That is a drawback of the company, and that's one of the reasons why people like trusts. And if that's a significant issue, then of course you would just continue with the trust, right? But just worth flagging, right? Nothing's perfect. I guess one way I've seen that framed is that companies are great for accumulating. They're not so perfect for withdrawing, right? So keep that in mind. So look, there's a bit of a shift in thinking here. For years, investors have tended to ask one question, which is, how do I minimise tax this year? But a more interesting way to think about it now is, how do I build wealth that survives for the next 50 or 100 years? Because they're very different objectives. If the trust tax advantages are substantially reduced, which is certainly the expectation, then the answer to the second question may increasingly involve private investment companies. Not because companies are perfect and not because trusts are suddenly bad. I mean, there'll be plenty of people who still use their trusts, but the relative advantages of each have changed. Look, just some final thoughts. The federal budget proposal may prove to be one of the most significant shifts in Australian wealth building structure in decades. When family trusts lose both income splitting advantages and capital gains tax concessions in 2028, investors will need to reassess assumptions that have been accepted for generations. For some families, trust will still make sense, but for others, particularly those focused on building and preserving long-term family wealth, the private investment company may emerge as the structure best suited in the new environment. All right, well, thanks for listening to another Financial Autonomy episode. I hope you found it valuable. The changes to trust, capital gains tax, negative gearing are throwing up huge financial planning opportunities and plenty of conundrums as well. So if you don't currently have a relationship with a financial planner, particularly if you're beyond the point where every spare dollar is going towards paying off the mortgage, look, visit the guidance website and schedule a meeting so we can explore whether there are opportunities that you should be taking advantage of. All right, Bye for now.